Hi, everyone. Can you hear me? Perfect. So I watched your conversation with Paul last year and found it fascinating. And I wanted to build on that conversation and really zero in on the finance industry, and for us to learn and understand the behaviors of that tribe and what behaviors to encourage so that the efforts around this room are long-lasting. So your book, Anthrovision, talks about tribes are shaped by rituals and symbols, and that also extends into the corporate world as well, and Wall Street's no exception. And I'm a creature of that tribe, and I'm told by your book and by others that we have a tendency to do acronym overload. So if I do that today, I give you full permission, Gillian, to ask me to explain myself. So in addition to being a Conduit member and meeting my colleagues at the Conduit Capital and Conduit Connect, moral money really increased my conviction on my timing to join this space. I had tracked the sector for the last decade, and true to my investor training, was assessing the right time to join this space. And for me, it was a homecoming. I grew up doing community service, whether that was with my dad on a Saturday morning, serving breakfast at an old people's home, or going to a rural South India to do a mobile medical camp. And what struck me about those models was how much capital constraints played a role in that, and that motivated me to go into finance, and in particular to learn about the different styles of investing. And the tipping point for me to move included the rise of really quality publications, including Moral Money. My favorite was the Thunberg Thunders, I think you did, was one of the first ones. And so, firstly, thank you for creating Moral Money.
Well, thank you for reading. Believe me, any journalist will love you immediately if you say they've actually read their columns. So thank you. And I love you all too if you're here for that.
And I would love for you to share what motivated you and inspired you to create Moral Money.
Well, thank you very much indeed. And let me quickly say a couple more thanks, which is, first of all, I'd like to say a very big thank you to Paul for asking me along tonight. And congratulations on how the club has grown. I actually went upstairs before I came here to meet with my amazing colleague, Kenza, who's just over there. Kenza, put your hand up, who's from Moral Money. She joined us a few months ago from a background in investigative reporting. If you've got any good tips, go straight to her. But we were having a drink upstairs, and I was stunned by just what incredible buzz you guys have created already. So it's great to be here. Yeah, exactly. And it's great to be part of this whole space at a time when the conversation is becoming more and more animated and lively, sometimes critical, but that's a sign of success, frankly. And certainly the ball is rolling in this space. You said earlier that we're twice a week. In fact, we're now 3 times a week because there's so much demand, and we may well grow further in the coming year. Now, in terms of Moral Money, people sometimes say to me, did you call this Moral Money when we created it 3 years ago because you wanted to be moral and preachy and tell people how to live, or because you were religious in some way? And I say no, absolutely not. We're not trying to be preachy or even aspire to any great moral philosophy. Some of you may have read Will MacAskill's brilliant latest book. You might know about his effective altruism campaign. And I admire it, but that's not kind of really what we're trying to do. We're not even necessarily trying to advocate. We're trying to illuminate a much bigger shift that I think is underway in finance. And in essence, what I think is going on is that if you look at the last couple of decades of the 20th century, the world suddenly fell in love with 2 ideas. One was that these clever things called computers and the internet could solve all our problems, and technology and numbers and algorithms could do everything. And the other idea was that basically, as Milton Friedman has said, the only thing that drove companies were shareholders, and there was no such thing as society, and you could have hard-headed business analysis in one corner and you could have basically this hippy-dippy stuff called caring about others in another corner, and you kept them totally separate. And I was trained as a cultural anthropologist, so I was trained to look at the hippy-dippy social cultural stuff. And I remember very clearly that on my first day at the FT, somebody very senior and highly esteemed, who shall remain nameless, found out I had a PhD and said, "Oh, what branch of economics was that in?" And I said it was actually in cultural anthropology. And there was a long pause, and he went, and it was a he, "Oh dear." But I guess really the real story of what's happened since 2008 or 9 is that people have woken up and begun to realize that the way the pendulum swung in the late 20th century went too far. And in many ways, we're coming back into a different realm where the different parts of my own experience are sort of coming together. Originally, that started because of the financial crisis. I think it's been intensified by other things like the rise of populism, the political crisis, the social crisis, and now, of course, the fact we're facing, in some ways, an economic crisis, and things like geopolitics are starting to intrude. And in some ways, this is absolutely nothing new, because the real reason I called moral money when I first proposed to the FT that we had something like this was not because I was trying to be religious or sound, pious. It was partly because I wanted to find a name that our Japanese owner, Nikkei, could pronounce. And moral money works quite well in Japanese, but responsible returns doesn't. But the key reason was, if any of you are Japanese or worked in Japan, you know what I mean. I worked in Japan for a number of years. So moral money works. But the most important reason, this is the key point I want to make, is that if you go back to the philosophy that Wall Street and the City of London and business schools are supposed to operate with, which is the gospel of Adam Smith. Everyone loves to talk about the fact that competition is wonderful and the competition drives innovation and growth. And that's all in his second book, which is The Wealth of Nations. But of course, his first book was The Theory of Moral Sentiments, which said you can't even get the framework to create competition without some kind of shared moral, legal, social framework which binds people together. So in some ways, what I think is going on today is that the two books of Adam Smith are coming together. We can talk about why that is and why the zeitgeist is changing, but I think that's the essence of what's happening today in many corners of business and finance. And that's what we try to tap into with moral money, and what the Conduit is trying to tap into as well. Whenever I meet grumpy Americans, or Republicans usually, who hate all this ESG stuff, I say to them, "Do you believe in Adam Smith?" And they go, "Oh yeah," because that's kind of the banner under which Wall Street operates. And I say, "Great, so do I. Try reading both his books."
I'm also glad that you did not listen to Sage, male colleague.
Yeah, the other thing I would say is some people said to me at the time, "Shouldn't you call it ESG something, like ESG Express?" I should say, by the way, some of you may know that, I write about this in my book, Anthrovision. The last chapter talks about how and why moral money came about and how it sort of plays into my bigger philosophy. But, I first had the idea of creating this back in 2017 when I got very irritated that I kept getting all these emails from public relations people talking about ESG. And I used to routinely delete them because I thought they were irrelevant compared to Donald Trump. And then I realized there was a reason why they were sending me these emails, and it was because the zeitgeist was changing, as I've said. But ESG was a framework that people were talking about. And, I thought, should I call it ESG Express? And I didn't, because I felt at the time that the whole movement or the shift in zeitgeist was much, much bigger than just ESG. It's about a way of looking at the world afresh, tying together the two books of Adam Smith, or to use another image I use a lot, going from tunnel vision, just thinking about shareholders, to lateral vision, trying to look at all the stuff that's not in the model, not on the balance sheet. So it's a much bigger zeitgeist shift. And I felt even back then that the ESG label was problematic and might not stand the test of time. And given all the debate right now about ESG and its potential challenges, I'm pretty glad that we didn't tie ourselves to an acronym that A, I hate acronyms, but B, may or may not last the test of time, the ESG acronym.
So let's talk about acronyms. So when you and I last spoke, we talked about the different types of tribes, shall we say, that there are. There's the environmental social governance, the ESG tribe. There's the social responsible investing, SRI tribe. And then there's the impact investing tribe. And I found that really interesting when we were discussing that, because from my observations, I've seen how these tribes can struggle with identity adjacent to each other. And therefore, there's much more conversation about the differences as opposed to spending time on what are the similarities between each other and how can they work together. And, we heard from Jacqueline Novogratz yesterday, who's the CEO of Acumen. She was here at the Conduit yesterday morning talking about some of those challenges that she faces on the philanthropy grant side to attracting impact investors. So I'd love for you to share with this audience, what are your definitions of each of those tribes, your observations of those tribes, and some of the advice that you have for those tribes as well.
Absolutely, and I'm really sad that I missed Jacqueline's talk yesterday because she is amazing. And again, kudos to the Conduit for getting people like her up here to plug her ideas into the London discussion. The way I'd frame this is this. Back in 2017, when I went around routinely deleting all these emails about ESG, because I thought it was boring, and then realized that I was being incredibly arrogant and dead wrong, or in anthropological terms, very ethnocentric, and then tried to think myself into the mind of the people who were sending me the emails and understand why. I then went back to my colleagues at the FT and tried to explain to them why talking about sustainability and ESG wasn't some weirdo hippy-dippy minority pursuit, but actually something which was coming into the mainstream of business. Because, one of the reasons why people like me and most journalists had been ignoring this stuff was because it seemed to be sort of somewhat irrelevant to the mainstream business story. And I sort of created a framework in my mind that I used to try and talk to people about what I thought was going on at the time, which I think is also quite helpful for the tribes as well. And it went something like this. It was a kind of 3x3 matrix. I literally sort of, drew it out on a chart and then tried to translate it into Japanese to explain it to the Nikkei, who very kindly gave me the money to create Moral Money. Thank you, Nikkei. But basically, what I argued at the time was that really starting in about 2016-17, there was a shift in 3 areas of the world, in the sense that companies, the C-suite, were suddenly waking up and realized that they wanted to do more than just make money with companies. They were rediscovering Adam Smith. Financiers were realizing they had to start explaining how they were making profits and at what cost. And the public sector and NGOs were realizing that they were running out of money to do their development goals and needed to find some money from somewhere else to do what they wanted to do. And these 3 things were coming together. And that was impacting, in the second column, the E, the S, and the G, environmental issues, social issues, and how companies were run. But also, this shift was being driven by 3 distinct motives. Some investors were actively wanting to change the world. They actively were on a campaign, they were activists to try and change the world. And many of them had been engaged in amazingly admirable ways for many, many, many years. Now, if you dialed back sort of 15, 20 years ago, those were the original first generation of people who were turning up at AGMs and making shareholder resolutions and shouting, or were deliberately trying to invest their money at a loss to support social causes. They tended to be mostly, Danish pension funds or some wealthy American trust fund kids or, nuns. And nuns were very important, by the way. Don't discount the nuns. The Order of White Lady in America did some extraordinary things at shareholder meetings. So you had the activists. And for the most part, that today is what impact investing is the, if you like, the heir to or heiress to. People who've often spent many years of their life deeply immersed in this and are extremely laudable, often worked at NGOs. And then you had a second group who began to realize in the early part of the 21st century they didn't really want to necessarily change the world, but they wanted to avoid blowing it up. And they wanted to avoid doing it harm. And that was a group that in some ways became the SRI group, the CSR group. They were wanting to make sure that they weren't actively doing damage to the world, but didn't really have a clear-cut mission about how they wanted to change it. And that group began to really come into companies, but they were often ring-fenced as a separate CSR department or SRI department or some kind of box-ticking department inside a company which was full of people who were not core to the operations. But then, starting about 2 or 3 years ago, or 3 or 4 years ago, there began to be a bunch of people who realized that all of this sustainability stuff was not just about trying to actively change the world or avoid actively harming the world. It was actually about avoiding actively harming themselves. And that's really important, because I strongly believe that much of what's driven the whole sustainability, ESG world in the last 2 or 3 years is a realization that what you're talking about is massive reputational risk. And not just reputational risk, but potential portfolio losses from stranded assets, the loss of clients, the loss of customers, the loss of employees, the potential loss of investors. Today, I think sustainability is as much about self-defense as anything else. And you can say that makes the whole thing pointless and cynical or hypocritical, or you can see that as a massive victory for the original group of activists who have managed to change the zeitgeist to such a degree that what's considered normal today is something that was not normal 20 years ago. It's an extraordinary victory in some ways for them. The idea that you actually suffer if you don't adhere to sustainability norms, that's a victory. And that last group, again, is very different. That last group tends to have come from mainstream business world. They often have a conscience too. They often really care. But they understand how the core of companies and business works. And they often, are very, very savvy and very articulate. And most importantly, they are often today in the core of a company's operation. Chief sustainability officers, all of those are in the very core of the operation. And inevitably, those 3 different groups have different backgrounds, different languages, and different incentives and motivations. And like any group, there are, misunderstandings, resentments, etc., etc. Doesn't mean that the movement is pointless at all. It doesn't mean there's not a big zeitgeist shift. But it's important to recognize the distinction between, say, impact investing and, ESG or the kind of reputational control that's driving many companies today.
Yeah, I think my key takeaway when we were talking about this last time is the recognition of identity between each of those tribes, because identity will then determine how each of them can actually work with each other and alongside each other. So we've talked about the 3 different tribes, which are all on the same side of the fence. Let's talk about and bring in the naysayers. And, there's live ESG warfare almost really happening in the US. So, somewhat got a frontline seat in that, Gillian. Like the anti-ESG state laws, that's 44 bills in 17 states. I think Texas was quoted on saying, it's dead on arrival. The Environment Protection Agency, so the Supreme Court ruling against the ability of that group to be able to curb CO2 emissions without congressional approval. Now, there is the success story of the Inflation Reduction Act, which is the rebrand of the Build Back Better plan, which is to the tune of $739 billion. And that's great for energy transition, but actually that has been reduced from the 3 trillion headline number. So I think it's worth just, keeping that in mind. So from an anthropological lens, Gillian, tell us, why is this happening? Why is this happening in the US?
Well, I think there are 2 things happening here. One is that in some ways, ESG has become so successful that people actually care enough about it to try and organise a backlash if they don't like it. I mean, when it was basically a bunch of nuns turning up at the shareholder meetings, the Republicans didn't even bother to notice it or care enough. The very fact that there is now a backlash is a sign, if you like, again, of success. So that's the first point to make. And there's a lot of money being poured into lobbying campaigns, into backlash campaigns, into all kinds of attempts to slow down this momentum. And in fact, Kenza and I were talking earlier about this because I interviewed Stuart Kirk, the former FT Lex head, who then went to run the HSBC asset management sustainability team, who came out at an FT Moral Money conference and basically lambasted a lot of the climate agenda. We didn't arrange it, but it was jolly good for our publicity. So thank you, Stuart. But the thing that Stuart was saying, amongst others, is that actually, there are all kinds of issues with ESG in his eyes, but at the end of the day, things like loans are a really effective way of putting pressure on companies. So it's no accident that if you start combing through what the Republicans are doing right now, they're really upset about banks that are not providing loans to fossil fuel companies. So as I say, it's a sign of success that the measures are actually biting. So that's one reason for the backlash. The other reason for the backlash, though, is that there are issues within ESG in the framework which are potentially challenging. And in the first flush of excitement about this, they weren't necessarily that visible, but inevitably, there's a history of financial innovation in any product area, whether it's leveraged loans, credit derivatives, default swaps, anything like that, is that what happens when someone has a bright idea is that you initially get an idea with tremendous amount of competing labels. You get extraordinary confusion about what these labels mean. You get a massive acronyms. You get extreme opacity. You get extreme hype. And inevitably, you get scandals. And then people come in and start exerting more scrutiny and saying, well, this doesn't work and that does work, et cetera, et cetera. And in some ways, that's a period we're in right now with ESG and sustainability, that basically, there was label confusion, there was opacity, there is still opacity sometimes. There's contradictions in some of the concepts. Guess what? That happens throughout finance. And those are now coming to the fore. And I think that's another reason for this war, this backlash. And it's made more intense by things like, the Russian invasion of Ukraine and things like that, where suddenly the energy equation is on the horizon. That's inevitable. I passionately believe that anyone who believes in the idea of sustainability or in bringing the two books of Adam Smith together shouldn't run away from this, but should actually welcome the scrutiny and the debate. I passionately believe that our job on Moral Money is to illuminate, not advocate, and that we want to capture all sides of the debate with the most transparency possible. So I've bent over backwards to make sure we get people like Stuart Kirk or Hester Peirce from the SEC, who was a Republican commissioner who hates ESG. We've tried to interview them for Moral Money, and we'll keep trying to do so, because we need to actually subject this to the maximum amount of scrutiny and challenge we possibly can if we're going to make it sustainable in the most fundamental way.
Thank you. And what do you think other jurisdictions can learn from this, what's happening out in the US?
I think they can definitely learn quite a lot, which is that, there will inevitably be a backlash. You need to look at lobbying structures, which are particularly bad in America, or particularly opaque. Money really is all about buying politics, or politics is bought by money in America. I think the other issue that people need to think very hard about is whether or not, in their desire and passion to move as quickly as possible to address the very real climate challenges, some of the activists and campaigners are in danger of running so fast that they get ahead of where business is. And there are two ways to look at this. One is to say that what activists and government officials should be doing is using a stick, not a carrot, and basically beating companies into submission and telling them they just have to comply with tightened climate rules no matter what. You can take that approach. In some ways, that's one of the ways that the Europeans are going. But you are likely to get potentially foot-dragging patterns in business. You may get a lot of arbitrage as well. One of the things that you see in finance always is whenever you get strict rules which are imposed on companies, whether it's Basel II or anything else, financiers will immediately start innovating to get around the rules and be creative. You know, Basel I, Basel II was what gave birth to credit derivatives. I sometimes worry that some of the European Union's approach to the climate rules and the green taxonomy is going to be like a green version of Basel II, where basically you immediately get bankers creating innovative products to run rings around the rules and bend them. So if you use a stick, you have the risk of that kind of behavior. But if you try and use a carrot and bring the industry along with you and tell them how beloved they'll be and how smart and how popular and how all their clients will keep wanting to work for them rather than working out, all their millennial employees will keep wanting to work for them. If you're trying to use a carrot to bring finance and business with you, then you probably can't move too fast, to be honest, because business takes a while to evolve. And, there's a very real debate about which tactic is better. I understand the fury of many green activists who say, well, we can't sit there and wait for business to grow up and get on board. But I'm also understand the realists who say, actually, if you move too fast, you won't get the backing of business and finance. I think that this is going to come to a head around yet more acronyms like the GFANs and the race to net zero and things like that, where there's now a very real behind-the-scenes battle going on about how quickly you can and cannot move in that area. I had one other thought I was going to make, but it's slipped my mind.
Well, talking about the rise in these different alliances.
Sorry, the
you
two other,
yep.
Yeah, trade-offs. That was the one other point I was going to make. ESG is all about trade-offs, but most people don't want to admit that. And I hope that a sign of greater maturity in the industry will be to say up front, there are going to be trade-offs between these different elements of the E and the S. And I think we should be looking at companies and asking them very explicitly how they're going to make the trade-offs. That was the other point I was going to make, because there will be trade-offs. And lastly, government. I guess the other lesson from the US is that you can't expect companies to do all of it. It is time for people to step up and ask companies to lobby government to introduce things like a carbon tax or to take public policy measures that at the end of the day only the government can do.
So COP26 is at 27, can't count, is around the corner. And in your last conversation with Paul, you talked about observing the silences as well as the noises between people, and that can give a real indication of what's happening. So tell us what observations you're seeing around the noises and silences between the two COPs, and what action you're hopeful to see for COP27 or come out of COP27.
Well, the first big silence is that actually there's not a lot of noise around COP27 at all right now. I mean, that's the most important one to say. It's really gone off the agenda. And, I've had a series of, every morning I take part in the Leader Writers Conference for an hour. And, I'm sort of having to remind people that COP27 is coming up. And I think the FT's more focused on climate issues than most of our rivals. So the first big point is that, COP27 is not on people's radar, and I'll be very interested to see how many people even go to COP27, compared to COP26. The second point to make is that there needs to be a lot of discussion about emerging markets and the very understandable fury felt in the developed world about both the question of whether they should be imposing the same kind of carbon emission reductions as the developed world, but also about whether the developed world will ever step up on things like loss and reduction and mitigation and adaptation. And what's happened in Pakistan in the last couple of weeks, which is absolutely shocking, indicates the scale of crisis that's barreling down the road towards us, and the degree to which, this really, really matters if we're going to get any kind of consensus on that front. And those issues are made a lot harder right now by the fact that a strong dollar and a weakening global economy is contributing to a debt crisis in the emerging markets. So that issue should be, right at the center of the agenda. Is something that we've written a lot about at the FT, but it's not all over the news right now elsewhere. And that's, again, another big area of silence. I guess other questions are, why on earth don't we have a carbon tax? Why is it so hard to actually get that implemented? I mean, Janet Yellen wrote a wonderful paper with people like Mark Carney just a few months before she was appointed US Treasury Secretary, saying what a good idea a carbon tax would be, or a carbon price. That's what she believes intellectually. Why is it not happening? That's, another huge question. And then there are other areas of silence, like, why aren't we talking more about methane? Methane's a really big issue, very scary. Why aren't we talking more about shipping, agriculture, those issues? So those are some of the things. But by the way, I should say, we're very keen on Moral Money to hear about any thoughts that you have about areas of silence that we should be writing about. We are, frankly, only as good as our community. And I'm really grateful to everyone who reads Moral Money. I'm very grateful to everyone who cuts and pastes it and sends it round to all of their colleagues, because although my FT commercial colleagues hate this, I think it's wonderful, so please carry on doing it. We have this remarkable thing on Moral Money, that we have a reopen rate of something like 5 times. And no one could work out why for ages, until I pointed out to them that everyone I spoke to told me they were cutting and pasting bits and forwarding it. So please carry on doing that. I mean, even better, take out a subscription to the FT, obviously. But, but in all seriousness, we are only as good as our community. We want to listen to our community. And if you do have areas that we should be writing about, please tell Kenza and the rest of the Moral Money team. And Kenza is over there, and there can be a queue around the block. So please tell us the things we should write about.
And can I ask about the actions? What actions would you be hopeful to see come out of COP27?
Well, obviously enhanced commitments towards emission reductions, tightening of targets. One of the things that makes me excited to be upbeat is a degree to which radical transparency may actually be helping to keep that on track and give people more leverage to push it forward. If any of you have not seen this new project that Al Gore has launched called Climate Trace, I strongly suggest you look at it, because if you're looking for reasons to be optimistic, the fact that there are now a gazillion satellites whizzing around the world tracking everything means that some people, like Al Gore's team, have the ability to start tracking in great detail where emissions are coming from. And I was at a conference in Toronto a couple of months ago where the Climate Trace team basically put a call out to all of the entrepreneurs in the room, and there were gazillions of them, and told them they would basically provide the open source data to anybody out there who wanted to create companies to find innovative ways to take this information and turn it into products to track emissions. So the fact we now have this extraordinarily rising radical transparency could be encouraging in terms of looking at what countries are doing. So that's obviously one thing. I hope there's a serious conversation about adaptation and loss mitigation for the developing world. I really do. They have to be at the table big time, otherwise nothing is going to get done. I hope that there is pressure brought to bear on China, and that actually not so much just pressure brought to bear on China, but also that China can bring pressure to bear on America as well, because we need to have both of them at the table. And it's very interesting that for all the extreme political tension between the US and China in recent months, there's sort of 2 areas that I can see where in fact dialogue is continuing. One is very bizarrely what the SEC did recently with the Chinese regulators in terms of audit of Chinese companies on US stock exchange. That was like came out of the blue. But that was like, the conversations there have been continuing all the time. But the other area where they are still talking to each other vaguely is on the climate side. There's still some quite friendly dialogue going on there, amazingly enough. Owes a lot to John Kerry, who is whizzing around the world in a truly frenetic way right now. I saw him recently, and he's literally going from country to country to country right now, trying to get all these people on board. It's a really thankless task, but he's trying to do that. Carbon price, I hope that's on the agenda as well, really important, or carbon taxes. Those are some of the things. What have I left out? You are the expert. I mean, listen, you have the podcast which tracks all this. What else would we be talking about? Tell us, and we will basically start trying to pick it up on Moral Money.
The indigenous voices, I think, is something that we've also come across as well, and just the consolidation of those indigenous voices, because right now they're quite fractious, and so not necessarily being heard. And even as sad to say is, they spend half the year trying to raise the money just to get to these conferences. So, how are their voices going to be heard if they're spending most of their time trying to do that versus resolve their domestic challenges?
Yeah, no, that's a really great point. I must say, one thing I find fascinating about the carbon offsets debate is that I think it's the only time in history when wealthy Wall Street bankers and hedge fund types have ever had any incentive whatsoever to talk to someone from the Amazonian rainforest. Because the reality is, if you're going to create a carbon offsets trading market of any sorts, somehow you need to put those two groups together. And they would never have any reason whatsoever to talk to each other, but to make it work, they need to. That's fascinating. The other thing I'd say is the MDBs, multilateral development banks, who, apologies to anyone who works for one here, but they really have not covered themselves in glory recently, either in terms of pushing forward green projects or actually plugging one of the really big missing chunks of this whole ecosystem, which is blended finance. And there's an urgent need for blended finance initiatives to start, to basically start addressing the question of who's going to fund any kind of transition in the emerging markets. The problem with blended finance, as I once wrote in a column, is that talking about blended finance to voters is a bit like a parent talking about spinach to a toddler, in that it sounds really worthy and everyone kind of knows vaguely it's good for you, but it's also really boring. But blended finance really matters.
I mean, there could be a separate topic about blended finance, particularly even in the investment community. I think there's very different views on the role of blended finance and how it works across the life cycle of it too. So I think there's much conversation.
Well, groups like yours are really in a very good position to try and push this forward, because I happen to be strongly in favour of blended finance. I know it's problematic, but I just don't see how else we're going to fund any of the transition that's needed in the emerging markets.
Yeah. So my career started pre-crash at Lehman Brothers. Not particularly... There we go. Exactly.
It sounds like a fantastic education for how to cope with a crisis.
And stayed there after the crash as well. And I really wish Moral Money was around to have covered that space and seen how that went, because I had a front row seat of seeing examples of good human behaviour and bad human behaviour. Good in that there was really pride around analytical rigour, and pre-crash, our returns were top quartile. Bad because, as human beings, they thought they would be feared of being judged alone on financial performance. And so that caused a lot of hesitation in terms of reporting, valuation, impact. And that, obviously resulted in loss of confidence and many other things that we saw after. You've seen and edited many stories. Love to hear which stories left an impression on you since you started Moral Money.
Goodness, I know whatever I say is going to offend somebody because I don't mention them. So, I mean, to be honest, I mean, I see Moral Money really as more a kind of tapestry that's woven of lots and lots of threads. And we're trying to weave together threads from all over the place to create this kind of tapestry of a changing zeitgeist. And I guess that's really the way I would see that, the tapestry, to my mind, has become much bigger than I ever expected. It's reached into areas which are, quite striking and I never expected to see. I've had many of my expectations constantly changed in the course of Moral Money. I first got the money to create it in the summer of 2019, and I actually said to everyone famously, well, I don't think anything very much is going to happen. We launched in June, and I said, or end of June, I said, well, it's a really rubbish time to launch, but nothing's going to happen in the summer, so at least we'll have a chance to test out the newsletter. And 3 weeks later, the Business Roundtable stood up and said that they were abandoning the shareholder first principle and going to stakeholders. And then suddenly Larry Fink popped up, and then Greta Thunberg popped up, or actually the other way around. And suddenly everything accelerated dramatically. And then COVID hit, and I thought it was a really rubbish time to have launched Moral Money, because I really thought, and in fact I wrote saying that I thought that the whole sustainability movement would slow down in COVID. Turned out I was 180% wrong. It actually, 180 degrees wrong, it actually accelerated, in quite a dramatic way. I guess what I find fascinating, and then of course we began to have the backlash. I guess what I find fascinating is that when we first started Moral Money, we spent a lot of time explaining to people why we were doing it and why it mattered. We've now shifted almost entirely to the how, not the why. But the other change is when we started Moral Money, 2 or 3 months after launching it, I then had almost every single PR on the planet knocking on my door saying they wanted their CEO to be profiled. And so we went through a phase where we did lots of profiles. And now it's quite interesting because lots of people don't want their CEOs to be profiled because they're worried about promising so much that then the activists will then come after them and expose that they're not doing everything that they had actually promised. And again, I find that quite encouraging in terms of, how the zeitgeist is shifting again. There's more credibility and more awareness of what's actually needed to try and get this change to stick. I can go on for hours about what I've noticed about the coverage, but yeah.
Thank you. I did have one more question, but I think we should go to Q&A.
Hello, thanks, Gillian. And by the way, thank you so much for all you do with the team.
I should say it's very much a team-based effort.
Yeah.
And I think many of you will have met Simon Mundy, who runs it on a day-to-day basis, who's brilliant. I think he's spoken here. Also Kenza, and then Patrick Temple-West as well, and Andrew Dedrick-Johnson. There's a whole team behind it now.
Sure. And I think it was a piece I want to refer to that I think Kenza wrote this morning about you started touching on it about the conflict on standards around ESG between GFANZ and Race to Zero. And the comment was, bankers in the US have privately expressed concern about being asked to publish their estimates of emissions attributable to their financing work. I mean, not knowing anything like enough about the opacity of the finance system generally, could you talk a bit more about banks and their role in financing both good things and continuing, new oil fields, for instance? Where do they sit in this whole debate if they're going to resist radical transparency, as you mentioned?
Well, they all sit in a pretty uncomfortable position, to put it mildly. And if any of you by the way, we're going to be writing a lot about the whole fights that are going on behind the scenes. And if any of you have hot tips, do please tell Kenza straight away. On all sides. And it's not just about banks, by the way, it's asset managers and insurance companies. Broadly speaking, my sense is that after Greta Thunberg and Larry Fink yelled at everyone, there was a huge fad and a dash to sign up to net zero commitments because it sounded good. And many CEOs actually generally wanted to sign up to them. They think, yeah, of course we want to make the planet greener. I'm fed up with my own kids at dinner table telling me that they're ashamed of me. And, it's a good thing to do. So everyone said, yeah, net zero target. I'll have one of those too, please. And then the effort started to try and actually work out what it actually meant in practice. And some of them thought, yeah, okay, well, we can make our own operations net zero, kind of in so-called scope one, i.e. what we're doing. And then they began to realize that actually what people were asking for was more ambitious and trying to make their borrowers' portfolios net zero as well. And then they realized that they were actually going to have some kind of timetable and a route to how to get there. And inevitably, that's now making many of them go, yikes. And that was happening even before the invasion of Ukraine and the energy crisis, and the energy crisis now has intensified that. So what happened in COP27, 26 to use another metaphor, is that all these banks came out through GFANs and said, okay, we want to be net zero by this date, and it's a bit like having a GPS system and plugging in the end destination and everyone agreeing on where they want to get to in the end. And then they all pressed their route finder, and the routes came out in different ways, and many of them went, oh, shit. And that's now sort of beginning to realize, that the penny's now dropping. And I think there's going to be a huge fight in the coming months about what they do. Can they actually be responsible for all of the emissions of all of their borrowers? Is it feasible to actually be trying to get from here to 2050 on a graduated way, or should they stave off most of the adaptation and adjustment till later? Should they be asking the same thing from all of their borrowers or not? Et cetera, et cetera. And that's going to be very tough conversations. But the good news that no one should lose sight of is the fact that they have now agreed vaguely on some kind of destination where they should be, even if they're not. And the good news is that there are ways of tracking whether they get there or not. And the good news is that the audit world and the accounting world is trying to crank up the pressure too. So that's the good news.
Thank you. And yeah, thank you so much. Like, I've been trying to put the beast of financial services to sleep, but like all this talk has reawakened me. I was around Lehman starting my career at the time you were exiting. So I had this perspective, which was we keep on being driven, especially from a very, I guess, Western framework around financial services, by short-term rewards, short-termism, like even within a company's structure, even within like a short-term 3-month cycle, every quarter, every shareholder update, the reaction to the markets, all of that kind of stuff, it kind of keeps on compounding a challenge we got. Is there anything, to kind of use your phrase around changing our perception of things, which gives us the ability to invest on longer-term horizons? Where do you think that conversation goes in terms of rejigging the financial system? Because it feels like without kind of unhooking ourselves from that addiction to short-termism, there's something awry with like the framework we're kind of putting on the
Yeah, I mean, obviously, we should be taking a much longer-term perspective in finance. Arguing for that is a bit like arguing for apple pie and motherhood. Obviously, the structure of most banks and hedge funds is geared up for precisely the opposite. In all kinds of ways. And obviously, the structure of most banks and hedge funds, and I wrote about this in my book about the financial crisis of 2008, Fool's Gold, is also geared up for making sure that individual teams tend to take a very narrow tunnel vision. And if you have any kind of remuneration system that's based on eat what you kill, or the profits that you make on your own books, then everyone's going to be short-termist. Duh. I used to joke that if nuclear power plants paid their employees according to how much electricity they could generate in a certain amount of time, they'd all be incentivized to blow up their plants the whole time, and that's kind of how banks have operated with money. So that's the downside. The upside, though, is that actually, if you look across the entire financial ecosystem today, there's something really interesting going on, which is that, one, private capital, as opposed to public capital markets, is becoming a lot more important. And some, not all, but some parts of the private capital world are actually more long-term in their perspective because they don't have to report to shareholders on a regular basis. And that's really interesting. And in particular, if you look at the swelling power of endowments and some public pension funds, parts of the life insurance industry that are getting more activist and long-termist, there's really interesting groups out there who are using their muscle and changing parts of the debate. And there are also some really interesting private financial groups that, again, are becoming more interesting in that respect. Some private capital groups are dreadful and very short-termist and just in for a quick fix, but some are actually really taking a much longer-term perspective. And there are also some family-owned companies which, again, are doing some very interesting long-term things. One of the problems with writing about them in the media is that, by definition, private companies are hard to write about as a family-owned companies. I mean, the financial media is basically set up to cover the public equity markets primarily. And so there's a massive bias in what we all focus on. But that gives me some little modicum of hope that some of the most interesting developments right now are not in the areas that the financial media tends to cover breathlessly and endlessly.
Thank you.
There's a patient hand right at the back there.
By the way, it's worth pointing out that when Adam Smith created his vision of markets, he worked at a time when the only companies out there were family-owned firms. So he actually took it for granted and didn't bother to state that commerce should have a long-term perspective and that there should be a natural overlap between the interests of managers and owners, because that was all he knew.
Hi. One of your rival publications a few weeks ago wrote an in-depth report saying that ESG should be abolished and all the focus should be on E, the emissions. How do you think that E, the S and the G should all have equal priority and importance? Or should some have, or is some more important than other?
Right. Well, by the way, I know which one you're talking about, and obviously admire them deeply. It's quite a sign of the changing times that they've even written about ESG, because until quite recently, The Economist, like most mainstream publications, didn't actually cover it. And, when we created Moral Money at the FT, we were the first mainstream publication to do so and to take it seriously. So there's, if you're on another side of the changing times, the fact you've even got that on the front page is quite a shift, or if you like, as a compliment to the sector. For its worth, I can understand why people would like to separate out E from S and G. I think there's some merit in it. I think trying to lump them together into single ratings is problematic. I do think that if companies are saying that they are trying to pursue E and S and G goals, they should be pretty upfront with investors about the trade-offs between them and which one they're prioritizing, because it's very hard to follow all three at once. And that's fine, but you should just be honest with people about what you're prioritizing. So I do think more clarity around this would be a good thing. I happen to agree, by the way, with Stuart Kirk. There's also need to be more clarity about the inputs and the outputs as well. But in terms of saying, okay, we should only track E and completely put S and the G on the bonfire, that I don't totally agree with, because actually sometimes, not always, sometimes the two things do go together. It's very hard to persuade people to embrace E if they are living in rotten S conditions or in poverty, etc., etc. You need to think about both of them at the same time. But also, at the end of the day, we have big social problems in the world. And I also happen to think that talking about the governance of companies is something which is a very good idea anyway, particularly in a time when so much power is concentrated in the hands of such a small group.
We have time for one more. There's just one over here. Yep.
Hello, can you hear me? It's Richard Perry. I own a company called CapXen, which is capital meets Zen. I also have a degree in economics from St Andrews, which ironically, old Adam Smith was born just down the road, didn't he? Yeah, you talked about the invisible hand. We used to talk about the invisible heart. Mm-hmm. And I think the capitalists picked up on the invisible hand and stole it and said, here's an excuse to be selfish. And so they forgot the heart bit, didn't they? Which is kind of what you're saying.
That's a very nice way of framing it.
Yeah, so I'm kind of thinking, I'm not a city guy or anything. I actually came from the pharmaceutical sector and explosives, so I can't claim any moral high ground. But maybe I need some help here. I'm trying to think of what I can do is combine the idea of private equity with the idea of employee mutuals. So imagine I'm a guy with a lot of money that can go in and buy companies and turn them into EOTs, such as John Lewis. So I can buy the company, I can make the employees own it. So I would call that mutual equity and not private equity. I don't know if that sort of thing exists, but I do believe that there are people out there that are like me. I could be naive or I could be a genius, I don't know. Or I could be an idiot. But am I going down the right road to think I can invest a lot of money, I could reinvent the dental industry by not just buying one dental practice, but actually I can just go buy Bupa or Portman and bring in my sort of ethical dentistry model or housing, you know.
Well, I think you're part of a movement that's saying that actually, you know, it's time to rethink some of the tenets of the company and the tenets of investment. And I think there's quite a lot of experimentation in many different directions right now about ways of doing this. And there are, you know, parts of the private equity world that are trying to act in a more responsible way. You know, I salute them. There are, you know, parts of the, you know, VC world, big parts that are trying to act more responsibly. It's often pretty hard to tell exactly what's happening on the ground because, you know, the devil's so often in the detail. But, you know, there are things like B Corps coming up, which are trying to, you know, have a different way of reporting what's happening and different priorities. There's a focus on stakeholder capitalism. There's all these different types of experiments that are going on. And I guess what unites them all is a realization that this very rigid vision of shareholder first, shareholder only capitalism that Milton Friedman had, you know, is limited. And, you know, people sometimes say to me, well, was Milton Friedman wrong? And I prefer to say that actually, as an anthropologist, I believe at looking at the context of people's ideas. And Milton Friedman was a product of his time, and a product of his time in three ways. Firstly, he came out in the 1970s, shareholder first capitalism, at a time when basically there was high trust in government after World War II. And people thought government could do stuff, and it was the government's role to solve social problems. So much so, by the way, that when the first generation of environmental activists came out in the 1960s in America, sort of Rachel Carson, Silent Spring, Silent Spring and the Rachel Carson movement didn't even try to talk to CEOs. They spoke to trade unions and they spoke to politicians. But they assumed that if anyone was going to solve the climate problem back then, it was going to be government and labour, not companies. Well, that doesn't hold true today because people don't trust government to do stuff, or they haven't been. They're increasingly looking to businesses to do stuff as well. The second way that Milton Friedman was a product of his time was that he didn't live in an era of radical transparency. I mean, no one had a clue what companies were doing except through shareholder reports. And even shareholders didn't know most of the time. And today, we have this monitoring companies all the time. I mean, never mind carbon emissions, you know, Glassdoor, employee Twitter accounts, all this kind of stuff. So companies can't hide anymore from what social zeitgeist is saying and ignore it. And that's changed too. And I think, you know, the other area where things have also changed is just in terms of, you know, what millennials expect and the degree to which they are or are not in love with technology and computing. Because the late 20th century was all about people believing that this magical thing called a computer could produce these algorithms and models that would measure everything that mattered. And economists could create models that captured all the really important things in life. And everything you could possibly want could be basically provided with a bit more technology and computing and numbers. And I think people have realized there are limits to models and computers. They're only as good as the inputs. And there's more to life than just numbers. And so that context has changed. And that's why I think stakeholderism is now the zeitgeist of today, lateral vision, not tunnel vision. And I don't think that's going to swing back again anytime soon.
I'm just going to say, if you want an example, my business partner worked with a guy called Jesper Brodin and said to him, your company is creating sea level rises. That he is the chief executive of IKEA, and so he helped him become a carbon neutral company. And what's interesting is the revenue went from 30 billion to 40 billion in the period of time. So they managed to nail it. And there's a book about it called Powered by Change. But if you're looking for an example, that's a very good one.
Hooray. Well, we all love IKEA for many reasons. And
Yeah.
there is another one.
Thank you, Gillian.
Well, thank you to all of you, and thank you to the Conduit.